I first want to start off by recognizing progress in this community, of course. Al just mentioned that he passed his challenge today, so we can incorporate that in there. Three members this week passed challenges, which is phenomenal to see that the progress is continuing regardless of the personal triumphs and tribulations that each of you are going through at your own personal level. It's so great as your mentor and as an individual who literally started this community because I wanted people to succeed alongside with me, that it's paying off for those who are being mindful of the inner work that they need to put in to really make this something that works for them, which I want to remind each of you listening that that is absolutely mandatory that each of you attempt to do if you want to make this work. It requires discipline, it requires detachment, it requires neutrality, it requires so many different aspects that you might not even realize that you're unwilling to put in because we've naturally been programmed to do everything that the market results in taking money from us in a way. Greed, overtrading, being angry, thinking that the market is against you with this victim mentality, over leveraging. There's so many different bad negative characteristic traits that the market exposes. And if you don't master those, then it will just consistently teach you a lesson. It'll consistently take your money and it will consistently result in just loss after loss after loss till finally one day you realize you're doing something wrong. And the thing that you do wrong consistently, time and time and time again, is what you really have to strive to try to, over time, not continue to do. And whatever that poison is for you, we each have our own different poison. You really have to hone in on it. All right. So, first, right off the bat, shout out to, of course, Kadir. Shout out to Dana. Shout out to Norm to Reality. Each of you all passed challenges this week. We got some lovely messages. Dana messaged me in the chat and said, I just wanted to take a moment to say thank you. A while back, I was really struggling with the combine challenge. I had some rough days, made mistakes, and I honestly started questioning whether I was going to make it or not. Instead of giving up, I went back to the course material, reviewed the bad days of trading that I had, and focused on the lessons that you taught about discipline, patience, and risk management. Little by little, things started to click. I stopped chasing the trades, trusted the process, and day by day worked on becoming more consistent. Today, I'm proud to say that I passed my 50K combine on my first attempt on day 42, which is crazy. That's 42 days to pass a 50K combine challenge. That's a month and a half, y'all, right? I know the work was mine to do, but your guidance, your education, and the amazing community you have built played a major role in helping me turn things around. I'm grateful for the knowledge that you've shared, and I just wanted to say again, thank you for everything that you do. This is a milestone, and I'm genuinely proud of it. And I wanted you to know that your teaching made a real difference in my journey. Much respect. So that to me, I wanted to bring up to everybody's attention because again, remember, there's no rush to pass these combine challenges. You can take as much time as you want. Most people won't. They won't take the time. They won't, when days are uncertain and they're not sure about the market price action, take time to be like, you know what? I don't know what's going on today, so I'm not going to force everything. I think even today, GYV mentioned in the Golden Dawn chat, where's the screenshot that she sent? Right here. This is extreme maturity, extreme maturation on the behalf of this individual, where she said, I've chosen not to trade right now, which is a big step because I no longer feel the urge to trade every day. I'm concentrating on learning and unlearning. This community is amazing. That alone, right there, where there's no loss, there's no win. It's just neutrality. It's understanding that you are not in a place, whether it's in your personal life or in your confusion on what's happening in the market, to not expose your capital. And this has now created an environment for her where she's going to go into next week and not have wins or losses on her mind, and instead just a blank slate to come back into the markets next week and reapproach things from a clear perspective. And this is what discipline looks like, right? And so stressing that that even for myself in my own personal career, doing the inner work, making sure that when I read a book or when I listen to an audiobook or listen to a motivational speech, I'm actually configuring ways in my mind to apply that and make sure that I'm not just reading something or accumulating knowledge thinking that it's going to be powerful without understanding that knowledge only becomes powerful when you apply it properly, right? So phenomenal work. I always just want to give respect where respect is due. So shout out to each of you all who passed those challenges today. And then, of course, those of you individuals who are still working towards those goals, continue to strive at those, obviously, of course, achievements. All right. Starting off with crypto, before we jump into the fundamentals, we're just going to take a brief look back at some things that we had been talking about months ago. So that way we can reiterate where we're currently at now and discuss where we were projecting that we were going to be. So we go back 2 months ago from a Zoom call that we had. You can see the timestamps down there. Just to recap, take a second and just listen, because now looking at where we're at in the current market landscape, the scenario that we had discussed as the possible worst case scenario, for crypto has now come into fruition. So we are here now. Take a second and listen. $0.3 trillion and that threshold breaks, and we see it start to act as a resistance, having previously acted as a support. Sellers overpower buyers that try to make an attempt to defend. It starts to act as a resistance, and we start to see lower lows and lower highs underneath of it. That is going to open the door for a much deeper retracement down into 2.05 trillion, which is still all right. So 2 months ago, when we were trading at about 2.4 trillion, when we had the rejection at 2.6 trillion, we had annotated that if we do not see price break above the $2.6 trillion threshold and turn it into support, that 2.5 trillion was going to be the next area of interest before buyers could make any formal attempt to absorb sell volume. And now, fast forward to today, we are here. All right. So with that in mind, now that the market is heavily discounted, now that we are in a huge bearish environment in crypto, this is now the time to start to consider exposing capital. It is not financial advice. You guys know my perspective in the markets, and I've told you guys in previous Zoom calls, especially yesterday, that I'm waiting to see if we can dump down into the August lows from when we had the yen carry trade unwind at around 1.8 to 1.7 trillion dollars, which if this 2.5 trillion dollar threshold gives way, we will see those levels come into fruition. But nonetheless, had you have felt like you missed out on any golden opportunities to get into projects that were rallying just a couple of weeks ago that have now pulled back, now is your opportune moment to minimize that downside risk, to maximize that upside return if you believe in the longevity of the digital asset space. Again, not financial advice, and I'm not telling you guys to go out there and that the bottom is in to start dumping unprecedented amounts of capital at these lows. But just thinking in terms of a long-term strategic investor, our goal is to get in when the market is fear. When the market is fearful, when the market's down $100 billion plus, when everything's bleeding and everybody's running away, we're looking at this as a discounted opportunity. Why? Because we weren't buying into the hype. We were preserving capital. We were talking about being patient and waiting for this exact scenario. And so had you, of course, listened to that, I know I sure did. I was not deploying capital at these premium levels. I wasn't chasing the rally. I wasn't thinking that we weren't going to get another opportunity. And I was trying to portray that to you all, not knowing that the future was going to unfold like this, but understanding scenarios. If we did not turn 2.6 trillion into support and go higher, then this was the most likely scenario thereafter. And so now we're here. So now is when that patience pays off, especially in projects like Hype. If you missed the rally, maybe you weren't able to get in on this last little retracement where we were trading at $60. Now look at that. You have an opportunity to scale into some long-term positions on Hyperliquid below $60. Right now, that's something that I'm looking at, as those are my first DCA levels to start facilitating some good higher form positions on Hype. And it's the same way across many other assets right now. All right, we're not going to get into that in too much detail today, but nonetheless, again, as a long-term investor that's not taking on any leverage, that's just looking for good DCA entries, now would be that time to start to consider how you're going to deploy capital. All right. So that was very interesting to see come into fruition 2 months ago. This community, probably one of the only communities on the internet that actually warned people about this. And I mean, just again, it goes to show the level of accuracy and maturation in this community alone. As for NASDAQ, before we get into my trade breakdowns today, all right, this is the beginning of the week report. So I want to just review this as well. This is from May 31st, where we talked about the if-then scenarios. And we can scroll down here and we can take a look at what we were discussing would be the bearish scenario, level to level updates, showing you guys the dark pool accuracy. We had highlighted in this screenshot that if we were going to see a bearish scenario unfold, it was likely going to target that weekly gap at around the 29695 dark pool to head us down into 29150. As our most likely bearish scenario, we take a look at the higher time frame on NASDAQ, right? Level to level, whether it's in crypto, whether it's in futures, whether it's in commodities, we stay relatively accurate. And so that's exactly what has happened. That gap that was created last week has now been filled, and the market seems as though it's starting to head towards that lower 2900 level boundary, that 29,000 boundary that we discussed. I don't think it's going to get there today. 29150 is a bit of a far stretch. Well, actually, hold on, let me change that. This still says 29400. We could end up coming down into that area of interest today. It's only a couple of points away from where we're currently trading at, but nonetheless, massive dump given the risk off market sentiment today. And so that overall analysis has materialized. But what I want you all to pay attention to real fast, okay, is the if then scenarios. Because yes, we can sit here and go over the if thens and say, oh, look, now we're accurate and we're right and it's come into fruition. But why has this happened? That's the important thing that you all need to be mindful of and understand in your own analysis that you're studying in detail. Because if today, for example, you were buying, right? You were buying, whether it was a technical analysis setup that you were seeing or just anticipation that because NASDAQ has been hitting new all-time highs, you were buying in today's environment, you were buying against the intraday trend. The intraday trend, having let you guys know in the Discord today, as I mentioned here, in the fundamental update, these are things to make sure that in this community you all are reading. Even if one day you didn't find it helpful, there's going to be days where you do. And so, for example, today I said, for now, I'm continuing to respect the risk-off narrative. As your mentor, whom you know has a 75% plus win rate and is pretty damn accurate most of the time, if I come in and I say in the morning, hey, this is why I'm remaining risk-off, then I'm not saying to use that as like a signal, but you at the end of the day should think to yourself, like, why is Cypress saying that? Maybe I should like do a little bit digging in the community and read some of the reports to kind of figure out why he's thinking that. And so with that being said, we go back to our May 31st report at the beginning of the week. And right here, I said to you all at the very end, I said, if negotiations in terms of the Middle East tensions break down, if oil spikes, if inflationary pressures and fears return, if the Fed rate hike odds rise, or if bonds sell off aggressively, we need to be prepared for risk sentiment to sour quickly. Right? That's how I ended the first start of this week's report. Now fast forward to today, right? So having understood the if-then scenarios that we gave at the beginning of the week and understand the fundamental backdrop, today, let's look at what happened, because exactly what we discussed would create the risk-off backdrop is exactly what is happening today. And so had you have understood that and you were buying today, well, you wouldn't have been a buyer because you would have understood that today the sentiment does not support aggressive buying in risk assets whatsoever. Like literally, there's probably zero fundamental drivers right now that support any type of buying activity. Risk assets today experienced another brutal session on Friday as investors aggressively de-risked across both trad, fi, and digital markets. At the time of writing, the total cryptocurrency market cap has fallen to about 2.06 trillion, while NASDAQ futures plunged towards the 29,600 level, reflecting a broad flight away from speculative assets and growth-sensitive sectors. The catalyst behind today's sell-off was not the single headline, but rather a combination of economic data, rising interest rate expectations, stronger treasury yields, and rapidly strengthening U.S. dollar. Together, these developments reinforce the narrative that the Federal Reserve may not only keep rates elevated for longer, but could potentially be forced into another rate hike later this year. The biggest shock came from the May non-farm payrolls report. Economists had expected approximately 85,000 jobs to be added to the U.S. economy, but instead, payrolls surged by almost double that, 172,000, while previous months were revised higher by an additional 93,000 jobs. This marked the strongest three-month period of job growth in more than 2 years and further demonstrated that the labor market remains remarkably resilient despite restrictive monetary policy. So that report alone this morning, which we got at 7:30, should have immediately sparked your, if you read the May 31st report, where I said to you all, if inflationary risks return and the Fed's rate hikes odds rise, it's going to be risk off. And so having a stronger labor market report, we in this community know that that's going to feed into the rate hike narrative and push back on the rate cut narrative. So instantly when that report came out at 7:30, an hour before the New York session opened, you should have instantly thought to yourself, oh, today's probably going to favor sells unless the environment changes, right? Unless something during the session changes, then we're probably going to see continued sell pressure. As we progress, for markets that had been hoping for eventual policy easing, this was the exact opposite of what investors wanted to see. A stronger labor market reduces the urgency for the Federal Reserve to provide economic support through lower interest rates. In fact, immediately following the report, interest rate markets aggressively repriced future policy expectations. Futures traders increased the probability of a Federal Reserve rate hike by December to nearly 70%. Again, if you all remember, I believe it was Tuesday or Wednesday, Iran, we had talked about the odds at the beginning of the week were at 42% of a rate hike come the end of the year. And we specifically mentioned, Ron had highlighted that if those odds start to inch closer towards 100%, we're going to see the market sell off. Now they're sitting at 70% on a Friday. Boom, there's another indication right there for you today to add to your risk off. I should be taking sell positions today, box checking, right? While some swap markets also fully priced in a quarter point hike by year end. This shift represents a dramatic change from earlier in the year when investors were debating how many rate cuts may occur in 2026. Today, the markets are debating now how many rate hikes will still be necessary. So a complete flip-flop from the previous market sentiment. As those expectations shifted, Treasury markets came under heavy selling pressure. Look at this. Treasury markets came under heavy selling pressure. What did I say? If bonds start to sell off aggressively, right? So there's another indication today how you could have been risk off. The 2-year Treasury yield, which is particularly sensitive to Federal Reserve policy expectations, surged to 4.15%, its highest level of the year. The benchmark 10-year Treasury yield climbed as well to 4.53%. Higher Treasury yields create a major headwind for risk assets because they increase the return investors can earn from government bonds while simultaneously raising borrowing costs throughout the economy. Mortgage rates, corporate financing costs, consumer lending, and valuation models for growth assets all become less attractive when yields move higher. This environment tends to place enormous pressure on high growth tech stocks and cryptocurrencies, both of which depend heavily on future growth assumptions and investor risk appetite. The US dollar also strengthened significantly following the employment report as investors adjusted to higher interest rate expectations. Capital flowed back into the dollar, pushing the greenback higher against most major currencies. A stronger dollar often creates additional pressure in the crypto markets because it tightens global liquidity conditions. When the dollar rises, financial conditions become more restrictive worldwide, making it more difficult for speculative capital to flow into risk assets. Historically, sustained dollar strength has frequently coincided with weakness across both crypto and growth equities. Adding to the market's concern is the, of course, broader inflationary backdrop that continues to challenge policymakers. Since the escalation of the Middle East tensions earlier this year and the disruption surrounding Iran and the Strait of Hormuz, energy prices have remained relatively elevated. Geopolitical uncertainty also added to the risk-off sentiment today. While the markets had previously been optimistic that the U.S.-Iran ceasefire agreement and the reopening of the Hormuz Strait were moving closer, recent developments cast doubt on that narrative. Continued fighting between Israel and Iran backed Hezbollah. Hezbollah's rejection of a renewed truce and reports of fresh Israeli strikes in southern Lebanon reminded investors that tensions remain elevated across the region. At the same time, Iranian officials stated that no tangible progress, we'll highlight that in bold, that's risk-off vocabulary right there alone within itself, had been made toward a broader agreement with the United States, reducing confidence that a near-term resolution is imminent. As geopolitical risks remain unresolved and energy markets stay sensitive to potential supply disruptions, investors continued reducing exposure to risk assets, adding further downside pressure to both crypto and equity markets. Rising oil prices continued to feed inflationary pressures throughout the global economy. This overall represents a difficult situation for the Federal Reserve, especially Fed Chair Kevin Warsh, as he prepares to lead his first policy meeting later this month. The challenge facing the Fed is that many inflationary drivers today are not demand-based. Higher interest rates can slow borrowing and spending, but they cannot directly lower global energy prices or resolve geopolitical disruptions. As a result, policymakers face the difficult task of balancing persistent inflation risks against the possibility of slowing economic growth. Unfortunately, as we wrap this up, for risk assets today, the employment report suggests the economy remains strong enough for the Fed to maintain its hawkish stance. Markets are now increasingly viewing the next Federal Reserve move as a potential hike rather than a cut. That perception alone is enough to trigger substantial repositioning across financial markets as investors reduce exposure to assets that benefited from the expectation of easier monetary policy. The result was widespread liquidations across crypto and futures markets. Sellers remained in control throughout the sessions as traders adjusted portfolios to a world where interest rates may stay higher for a prolonged period of time and inflation remains stubbornly elevated. For now, the macro picture remains firmly risk off. Rising treasury yields, a strengthening dollar, elevated oil prices, and increased expectations for additional Federal Reserve tightening continue to create a challenging environment for both crypto and equity bulls. Until markets receive positive headlines around Middle East tensions or evidence that inflation is cooling, especially considering next week and the week after we're going to get CPI, PPI, and core PCE figures, energy prices are stabilizing or the Federal Reserve is moving away from the possibility of further tightening, risk assets may continue to face significant headwinds. Today's sell off, we have to remember, was not simply about one jobs report. It was the market repricing an entire interest rate narrative, and that repricing is now being felt across every major asset class. All right. So, when we have what I would really love to do one day when myself and Uzi have the trading floor up and running, regardless of where that's at, is have a fundamental analyst come in and explain how important this stuff is for everybody to understand. Because in reality, this is probably one of the key drivers as to how I've been so accurate with my analysis across the board every single day, day after day, is making sure that I check this stuff and starting from the top down, making sure that my analysis is mature enough to understand the liquidity backdrop, that we as retail traders have no control over how the market moves. And so we have to move in tandem with the liquidity backdrop. And if the liquidity backdrop, if we as retail traders are trying to buy, but does not support buying opportunities, then we're going to get wrecked. Right. And so that is why this stuff is important, is extremely important to understand in your analysis, regardless if you like fundamentals or not. It'll keep you in a loop with why the markets look the way that they do today. So that is why today we're seeing this outflow. Now let's go into today's trade breakdown. So as always, starting on the 15-minute time frame before we get into the detail. I was simply coming into the beginning of the session, marking the Asia session highs, which came in at the dark pool at around the 35.87. And remember yesterday on the Zoom call, what I had noticed, I went over this for you all as well. All right, so one thing that I was paying attention to yesterday was I noticed this market maker pattern where they every single time a new high was created, instantly following that, sellers would trap those buyers and make new structure lows. And this was kind of that analysis yesterday that I had drawn on in the recording. And then yesterday during Asia session, that analysis came into fruition. We rejected the 35.87 range. We broke briefly above the AOI that I had identified, but nonetheless, the overall trend was correct. I had mentioned that we constantly kept seeing highs being taken and new lows made. And that trend continued today into New York session. So here coming into the new day's worth of price action, we have a new daily high, which was here during Asia session. Then after the new high was created, a new low is created. So we can see new high made right here. You're asking yourself the question after a new high is made, do the bases that led to that new high hold? All of them were completely shifted and violated. So this, we can clearly see that the liquidity flow of the market makers is to the downside until what? Now coming into this New York session, which opened here in this area, we have to understand that we are in a bearish environment until this most recent structure is broken, right? Where if we're taking buys from these lows, it's high risk. The best opportunity to take buys to shift from the bullish or the bearish bias to the bullish bias would be if the last bearish leg was violated with bullish volume, and we didn't get that. So coming into the New York session today, I was instantly thinking to myself, even if, because obviously, of course, all this price action hadn't happened yet, even if we see New York session push price up into these areas, I still have to be considering that we could see sellers defend and we could still see a sell-off, right? So that was one thing that I was thinking today. The second area of interest coming into this New York session, I was highlighting the London session highs, where the London session highs, pre-market session, continue to do the same thing, even though it's a lot tighter than how the market makers moved price during Asia session, where they liquidated highs and created new lows. If we pay close attention to what the market makers did during London, they actually did the same exact thing, where every single time buyers tried to make an attempt to engulf sellers who previously became aggressive enough to break supports, leaving behind an area where a passive seller is likely to defend. And interestingly enough, this also happened at a dark pool. Every single time during London, buyers made an attempt to become aggressive, sellers just defended, pushed price back to the downside. Here you see another attempt by buyers. So look at the effort and what's the result? So here's the most recent structure from A to B. The result of this effort just turns into a new bearish leg. So coming into this New York session today, yes, overall, I was seeing that we were in this bearish leg here, but on the micro, I was seeing that we were in this bearish leg from A to B. Why? Because coming into the New York session open, which was right here in this area, this is the new structure formation that broke a previous support and created another A to B move. So my second area of interest was saying to myself that until we can see bullish price action above this high, I will start to reverse my bias bullish to see if we can come up into this high to take profit, because we're likely going to see sellers defend, but I'm still overall bearish. So these are my two areas of interest where I was thinking today sells from, right? Until we see bullish price action above, we have to be in the seller's mindset, because that's what the market makers are telling us, right? There's no bullish price action yet until the opposite happens, where we see higher highs and higher lows above where market makers were previously making bearish price action, right? So that was my mindset going into the onset on the 15-minute chart. So I simply highlighted from these candlestick wicks and engulfed that over to the right-hand side as my 15-minute AOI, my second one. So same thing, as above, so below, right? These were the London session lows. These are the Asia session lows. So thinking about this in terms of buys, same thing that we do. If market makers are going to buy today, these are the two areas where they were likely to do it from. Just like today for sells, these are the two areas where they were likely to do it from, right? So with that in mind, coming into the first trade today. So of course, I don't trade the session open. The session open was in this candlestick here at 8:30. So you guys already have my higher time frame analysis. You already have my fundamental backdrop. We were also trading beneath the 15-minute AOI here and this 15-minute AOI up here. Couple that with a moving average crossover prior to the session on the 15-minute time frame. So think about the reasons, the confluences I'm stacking in the back of my mind as to why I'm taking sells. I'm thinking, May 31st, I wrote a report that says if this, and this happens, markets are going to be risk off. And today, when I checked fundamentals, this, and this, all the things that I said were going to weigh on market sentiment are unfolding in real time. Second thing I'm thinking about is how 15-minute AOIs are, of course, showing us that we're in a seller's environment where we're not making any bullish order flow right now. We're still seeing price make attempts to break higher. Sellers are absorbing that volume, playing passive defense, pushing price back down into new lows, and making new ranges to the downside. Third thing, I'm sitting here on the 15-minute time frame and price is trading below an EMA. On top of that, a previous analysis that I had given you guys just to throw in there in the mix was that we were likely going to target this gap from that weekly price action that took place last week, which was right here. So all those things in mind, then jumping down to the lower time frame after the market open, this is what I was seeing. All right, so right off the bat, prior to the session, here is the session open candlestick at 8:30. This big bullish candlestick, or this fake out, this trap here. So now considering everything that I had identified on the higher time frame, remember this is my London session area of interest here. And just keep in the back of your mind as we go through this breakdown, remember I said on the 15 minute, this is the first area of interest where if I was going to be a buyer today, I would want to see bullish price action above. So coming into the session open, which is here, you can see clear as day, we are not getting that bullish price action that I would have needed to see to reverse my bias from bearish to bullish. As a matter of fact, we were actually seeing the opposite. So, talking through this here, you can see it says buyers trapped before the session opened. There was a huge absorption wick. This is a signal that buyers are getting trapped and that passive sellers are defending this area. So you can see, remember we talked about these wicks. There's a huge wick to the upside, and then it instantly breaks a previous support and creates a new structure formation or a new A to B move, or continuing the overall order flow to the downside. So I noticed that on the 1 minute time frame. Then you can see here, after price breaks the 50 EMA, so these buyers are going to test the strength of the sellers here. Notice how buyer strength is tested, but excuse me, this is supposed to say seller strength is tested, but buyers cannot hold the base. So you can see here, after the sellers defended this high and created a lower high compared to the previous one. So you can see this high did not take out the previous one. That's a signal that sellers are trapping buyers. But not only that, you can see that we did not turn the 50 EMA after breaking it into support. And then once sellers started to become aggressive and push price back down into the buy base, what do you notice? If this is real buy volume that's going to take price higher, the base should hold. And instantly upon the retest of the base, you can see there's no bullish reaction from it. Every single time that buy volume comes in, it just gets engulfed by sell volume, and we start to make lower lows and lower highs inside the base. That is a 110% red flag that this thing is about to dump. If you come into a buy base and you don't instantly see bullish reactions and instead you see lower lows and lower highs, get the heck out of your buy positions. So sure enough, I annotated that prior to the session. We had another continuation to the downside or a new A to B move where we created a new bearish leg, right? So coming into the New York session, considering that from the top down, fundamentals, higher time frame, and now the 1 minute time frame, we are all bearish on across every single account. I was thinking in my mind, because I personally don't do this in real time, I just have the fib kind of like embedded into my head. I was thinking if I were to take a fib from this high down to this low, which if I do it for you all, you can see from the high down to the low, this would be my premium range, where if price was to sell off, this would be the area where they would likely attempt to do it from. And you can see price right at the session open. Buyers tried to make an attempt to absorb that sell volume and come in. We tapped into the 79% premium. Sellers trapped the late buyers and came in and completely dumped the market. So because I don't trade the first 5 minutes of the session, I, of course, did not catch the first execution of the one up, one down candle for this trade. And I simply trailed this bullish price action with a sell stop. So you can see here, I said I entered due to price trading below the EMA. So you can see as soon as we see this bullish move, price instantly engulfs the EMA, comes back after not breaking the previous sell wall, after respecting the 79% premium. And it says here, after price came back below the EMA, bearish order flow, price keeps making lower lows and lower highs with buyers trapped. Perfect entry for sell stop below the support. So this is where right beneath this bullish candle, I had my sell stop because it gave me the opportunity to trade after the 8:35 a.m. window. That sell stop was activated. My original stop loss was a bit lengthy on this trade, just in case we saw the buyers make some formal attempt to defend this base. But as soon as price started to respect the EMAs and we created this lower high right here, turning a previous support into a resistance, that is then when I started to trail this stop loss, take it into profit, and I rode this trade all the way down to my first AOI, which on the higher time frame was an area of interest where buyers could defend where they were buying from in previous sessions over to the left-hand side. So I closed the first sell position here, right? I'm not going to sit here and act like I held the whole entire thing. I did not. I think right here on this trade is when I made roughly about 1,200 bucks times my 5 accounts. Then to come in for the buy positions, right? Because I did mention in the chat this rising that I would be paying attention to see how buyers reacted to discounted prices. And so now, obviously, of course, hindsight looking back, this trade, had I have held it, would not have worked in my favor, and the overall momentum for the day was fully sells. But nonetheless, I still executed these buy positions with good sound confluences. So you can see here, I wrote price came into an area on the daily where New York session bought from in the past, where buyers would likely defend. And so in my defense, you can see the market maker pattern. We liquidate a low, and as soon as we see this wick beneath a low, instantly we see buy volume that engulfs two previous bearish candles. Instantly following, sellers testing the strength of the buyers in this area. You can see that we create a higher low in comparison to the previous one. That creates a new market structure high. So now we have broken two previous market structures. This one here and this one here. So I simply highlighted this last down candle before the up move and said to myself that if price can respect this base, I'm going to start to make an attempt to look for buys. So sure enough, after the retest in this bearish candle, I trailed this price action with a buy stop. That buy stop was executed with this next bullish candle. And I closed this trade at literally the perfect time. I annotated this in my journal today, not marrying a bias and thinking that the market's going to give you more, and being locked in and fine-tuned with what price action is telling you in the moment and areas of interest, and making sure that you have a profit-taking methodology is of key importance. Because had I have gotten egotistical today, this trade would have burned me. The reason why I took profit in this trade was because of here. We see this up candle followed by bearish engulfing candles. This to me signaled that there was a buyer that made some formal attempt here to try to absorb the sell volume and got trapped. And so I was sitting there saying to myself that upon the retest of this bullish candle, if we do not see buyers break through this area and turn it into support, where you can see a previous resistance would need to act as a support in order to take price higher, that this would be a perfect area where we could see buyers get trapped again and start to see sellers overpower. And so sure enough, literally as soon as we tapped that area, I shaved, I think it was 4 contracts off of a 5-contract trade, moved my stops into break even, and then this pullback took the rest of the 1-contract trade floating out. And then after that, I was up for the day. I think I made about $2,300 or 2,500 bucks at times my 5 accounts on a Friday, which is phenomenal. It's about 10 grand. And I just watched the rest of the moves play out. I wasn't trying to chase because obviously, of course, the RR on the higher time frame, considering that the 15-minute AOI, it was all the way up here. I wasn't trying to execute trades all the way down here at the bottom in these areas. I was a little bit skewed that my RR would be off. So I didn't chase any of this, and I just watched it unfold, which was just kind of great to see to close out the rest of the week. All right. But nonetheless, my sells to buys, phenomenal execution across the board, good sound confluences, not second guessing myself, understanding here in this buy position. My best takeaway today was journaling that the market doesn't owe you shit. So if you're in a buy position thinking that it's going to go higher and you don't have a profit taking plan, that buy position could go against you just as fast as you got into the trade, right? So those are my breakdowns from today. Nonetheless, now we can kind of see where the market's at. I wouldn't be surprised if closing this off, we constantly see people try to come in to buy this drop and they just keep eating that liquidity. And eventually we closed this week at the 29,150. So we'll see how this unfolds. But nonetheless, those are my trades for today. I'll leave the floor open for discussion. I hope that that breakdown from start to finish, again, I'm so sorry if reiterating stuff that we went over at the very onset of the week sounds arrogant, like it's me trying to say I told you so. It's not. It's me trying to take this game seriously and get you all to see that there are levels to this game. There are levels to understanding what's going on in the moment and how to react to price action accordingly. And it's my way of an attempt to show you guys that you can do this as well. You can do this through thorough understanding of the markets that you're operating in and through thorough understanding of yourself. And if you combine those two things, trading these markets becomes relatively fluent. It's like drinking water. It's not challenging. The challenge only becomes when you're going to take profit and how much risk you're going to put per trade. That's really it, right? So that's my breakdown for today. Congratulations to those of you all who absolutely freaking killed it this week. And for those of you all who are still taking L's and learning lessons, don't give up, right? Because you only ever lose when you give up, to be completely honest with you. You don't lose in this market when you lose money because the markets don't give a fuck about that. You can come back to the markets time and time and time again. Even if you lose money, you only lose when you give up. When you say, you know what, trading is not for me, it's not something that I can accomplish, then you've accepted defeat. If you never do that, then you never lose. And there's always the potential possibility for you to rise above the odds and the standards and the statistics. And especially in this community, be the one or be the type of individual who's taking payouts and passing challenges and managing larger amounts of capital. That future is a future for each and every single one of you all who actually puts in the work, the self work, the inner work first to then understand the markets. All right. So that's my spiel for you all today. I'll leave the floor open for questions, comments. If you guys want to break down your trades or just have casual trade talk, we can. And if not, then everybody enjoy your weekend and I'll see you guys next week. Floor is yours.
Hey, Cypress.
What's up?
Tony here.
What's up, Tony?
Quick question. Th- Thanks for the breakdowns. These things are awesome. I've been studying these, but what are your thoughts? Okay, I guess I could share my screen and talk you through it probably a little quicker. Hang
Yeah,
on,
sure,
just
brother.
a
Let me stop sharing mine and then give you the ability
oh,
to share
okay.
yours.